All right, so again, this session is being recorded. Today is Wednesday, day 2 of class. We're going to talk a little bit more about lecture 1 in just a few minutes. But before we do, I wanted to make you aware of a challenge that we're having with Bloomberg that we've been finding out over the last day or so. So apparently the instructions we were given are not correct for signing up for a Bloomberg account. We need to do some clarification here. So I want to start by saying there's actually 2 Bloomberg accounts that you're going to need. There's an account to log into the terminal, and there's an account to log into the BMC certification. And they're actually 2 separate accounts, 2 different usernames, 2 different passwords. So in the files section, share my screen. There's a folder called Bloomberg, and in this folder, there's a PDF called Student Terminal Access. This is what you're going to need to get your account for the Bloomberg terminal. And what's important is under login instructions, you need to request a Bloomberg terminal login because you won't have one, right? And essentially, what you're going to do to request the Bloomberg terminal login is you're going to go to this link and request the user and password through the BMC portal for the account. Now, very importantly, when you go to this link, you can't put in the class code, right? Because unfortunately, the class code screws things up. So I know you told you to use a course code, but you can't use the course code. So practically what that means is screen number 1, where you type in, I'll get a screenshot here. Did this myself earlier, I was playing around with it. So basically you go here, sign up. You sign as a learner. On this screen, you'll type in your name, put in your university email address, choose a password, do the capture, hit sign up. It'll bring you to a second screen, which will look like this. Have a pop-up, and it'll say, we're going to send you an email to confirm. You'll hit OK to the pop-up, and it looks like this. Do not say you're taking this as part of a group and type in a class code. Apparently, that's causing a problem. So the actual answer, ironically, is to say, no, you're not taking this as a group and don't put in a class code. When you then check out and do this, then it will give you an account tied to a serial number, which will allow you to get into Bloomberg. If you type yes and type in a class code, when you get along into Bloomberg, it's going to tell you you don't have a serial number and to contact your professor or Bloomberg for assistance, right? So that's the mistake. If you've done this process and you got that error, you need to send me an email. And I'm compiling a list. Right now it's about 50 people that did this. And I'm going to mail it to Bloomberg and tell them that you guys are having problems, and then they will manually give you a serial number so you can continue on. If you're not done this, then when you do sign up, don't sign in with the class code. Then, this is also very important, when you try to log in the terminal to do your assignments, unlike BMC, you need to go to this login. It's going to look like this. And so this is the login and password that you will type in that will give you remote access to Bloomberg, okay? So you don't access Bloomberg through the portal. You can't get there. You only go through the portal to create an account. Once you have that account, you have to go directly to the other link, use that account to log in. If you log in and it says you don't have a serial number and you don't have access, once you've created the account, it's because you use a course code. And ironically, the course code is not what you want. And again, just in fairness to Bloomberg, they're not really set up to do what they're doing with the university. They kind of, my guess is they probably kludged it. And when they did, they made it accessible to the umd.edu login, and the class code unfortunately screwing them up. So I'm going to remove the class code. You don't need it for anything, because even with your certification, when you do the certification, the class code does not matter, because you're going to prove to me that you did it by sending me your certificate and sending me your scores. So again, questions about any of this? Sorry for the confusion. Just want to get everybody back aligned.
Professor,
Yes.
but I registered with the class code and everything yesterday for the BMC, and I was able to like do the models studying. So is that any?
If you can get in, then don't worry about this. These are only for the people that are locked out.
Okay.
Because one of the things about the class code is that, and I'll show it to you on the terminal.
Okay.
Like, let's say that you actually logged into the terminal. So this is the actual, I'm logged in a terminal here. So if I go to the terminal and I type in BMC, what you actually have to do, even on the terminal, is you have to sign up for BMC, which means when you sign up, you're going to create another account, which is not your Bloomberg terminal account, but you create a separate account for BMC just to take BMC. So BMC is actually a completely separate account than the terminal account. Okay. So if you created this BMC account separately to take it on the web, it doesn't affect your ability to take Bloomberg itself. But because it looks very similar, like here, if you say you're taking a part of a group and you type in your class code, I already have a Bloomberg account, so it's not going to matter. But if I don't have a Bloomberg account and I'm signing up for a Bloomberg account for the first time, I couldn't even get to the screen, then typing in a class code doesn't give you the serial number to actually let you log in remotely. It's just the way Bloomberg is handling the security. They messed up, but nonetheless, if you're in that situation, you can't get into the terminal, then send me an email and I'll add you to the list, because I'm emailing it to them later today.
Okay.
Other questions?
And for each of the model, you require minimum 70%.
Correct.
So what if one of those I got under 70%, like, can I redo it?
So if you did take it and you did get under 70%, you would have to redo that section. You don't have to redo all the sections, but you have to redo that section.
Okay.
Now, your situation gets more complicated because Bloomberg does not allow you to redo the section as part of the certification. So what you'll have to do is create a third account. You'll need a new umd.edu email address. It's not the one that you registered, but still umd.edu. And using that third account, retake that section.
I'm halfway and I got like above 70%, but I'm just asking in case.
Yeah. So I'm just saying, so as long as you get over 70%, you're good. But if you get under 70% in a section and you need to retake that section, you'll need to create another account to retake that section, because it only lets you take that section one time.
Okay. Thank you.
So yeah, so basically pay attention when you're going through the section.
Yeah.
Good call out. Other questions? All right. So continuing on for purposes of today, let's go back to lecture note 1. All right. So one of the slides I'd skipped over on Monday was called Buffett's Rules. And this is actually just going to help us understand how we're going to start assessing industries and companies throughout the semester. So Warren Buffett, who runs Berkshire Hathaway, is their chairman, has been a very successful stock picker over a long period of time, because what he says is he doesn't invest in companies. He invests in industries because the industries are more important. Then he picks the companies in those industries that he thinks are going to do well. So translation, the industry is about 50% of the performance of any business. So if you're in a good industry, it's much easier to make money than if you're in a bad industry. Rising tide rises all boats. So we are going to define industry attractiveness based on spread. An industry that has a positive spread, an ROIC greater than its WACC, is a value creating industry and therefore is an attractive industry. And the more spread, the more valuable it will be. An unattractive industry is an industry with a negative spread, ROIC minus WACC being negative. Okay, that is how we're going to define an unattractive industry. So in this class, financially, the way that we're going to define attractive and unattractive industries based on positive or negative spread. In this class, the way that we're going to define competitive advantage is performance relative to peers. Okay, so the idea is that competitive advantage means you do better than the other people in your industry. So just because you create value doesn't mean you have competitive advantage. It could just mean that you're at the right place at the right time. Because you're in an attractive industry, it's easy to make money. Whereas the opposite could be true. You could be in a very poor industry, but you do less poorly than everybody else. And so you're still better than they are, even though you're destroying value. That could still be competitive advantage. So rather than the more ubiquitous, everybody is good at something competitive advantage definition that people like to use, in this class, we're going to use a definition that if you don't outperform your peers financially, you do not have competitive advantage. So spread relative to peers, relative spread, is how we are going to define competitive advantage. Okay? And that's what's going to be important for your assignment next week. It's due on Wednesday, as well as the way that we answer questions throughout the semester. All right, so let's apply this back to the real world in Bloomberg. So we're going to go back to Bloomberg. Let me share the Bloomberg screen. All right. So somebody give me a company. Any publicly traded company.
Apple.
All right. APL is your ticker, or I can type in Apple. And as we type in down here at the bottom, it'll start sorting out the securities. Now, Apple, that's their stock ticker, AAPL. US means it's a US company. US trades in the US markets. And then equity is the stock, corp is the debt. Okay, so Apple US equity is what we're going to look at. Get you the equity screen. And for purposes of the competitor analysis, we're going to go to RV, which stands for relative valuation. Now, on the RV screen, it's going to give you default competitors, default peer list. And up here is the comp source, which is the competitor source. And it basically has different sources. Now, one of the comp sources is called the analyst curated BI. And the analyst curated means somebody at Bloomberg went through and picked who they thought the competitors were. So for global handsets, these are Apple's competitors. I could change the industry. Second comp source is the algorithm. BICS means Bloomberg Industry Classification. So there's a computer algorithm at Bloomberg that's guessing who they think the competitors are, and that's this comp source, right? Now, you also have the ability, by clicking on this little pencil-like button, to create your own comp source. So you can put in your own securities or red X out securities and look at your own peer group. And finally, I'll go down here. You can go into, like, for example, the Global Industry Classification Standard. So GICS is basically standardized across countries, where it's an 8-digit code. And when companies register, they register 8 digits is the sub-industry, 6 digits is the industry, 4 digits is the industry group, 2 digits is the sector. That's actually how governments put companies into standardized lists, and this is now the global system. It used to be called standard industry classification system or the industry classification system, and now it's actually modified into the GIC system, but these still are legacy system. But the point is there's different ways of looking at comps. Ideally, we want to use analysts curated, but if they don't really have a lot, you can go to GICs or something like that. For this assignment, as long as you have a decent sized peer list, I'm not going to complain. Now, back to the peer list. This is the peer list, and these are some default templates. So if I click on comp sheets, I can then click on a sub template, like for example, profitability. And this is the default profitability template with all of the profitability ratios from the income statement. These would be all the balance sheet ratios for these companies. If I clicked on credit, these would be the credit ratings for these companies. Right? Now for homework 1, you're going to click on custom. And we're going to do this based on a custom template. Now, when you get to the screen, your screen's actually going to look under settings, global settings. It's actually going to look like this. It's the default screen in Bloomberg before you change anything. And it's going to have this kind of ugly looking bar near the top of the screen, which in my opinion just wastes a lot of space, right? So I don't like this bar. If you want to keep this bar, you can keep this bar, but I'd like to actually see more data on the companies that I'm analyzing. I don't find this information to be particularly useful. So what we're going to do is we're going to go to settings. We're going to go to global settings. We're going to take show top section. We're going to uncheck that. We're going to hit close, and that's going to remove this kind of ugly bar and just give you more company data that you can see on the list. Okay. The other change we're going to make under settings, global settings to your account, this is individual account, everybody can have their own account doing it this way, is we're going to go down to stats, which is statistics, and we're going to click on market cap weighted average and average, and then hit close. So that way, every time you load this screen, Bloomberg is going to calculate an average and a market cap weighted average for all the data that's below. Now you'll notice that the market cap weighted average right now is 0 because there's a problem with Bloomberg. They have a bug in their system. I actually reported it to their tech support, and their global support is looking into it today because they realized they screwed up somewhere. Somebody made a programming error, right? But average is working, market cap weighted average is not. And so the idea is the average literally does that. It takes all the numbers below and it averages them out. The market cap weighted average averages all the numbers below based on the market size. So small company doesn't distort the average. Now, for purposes of the assignment this semester, we want to use market cap weighted average, right? Because again, I don't like small companies distorting my industry average. But since that feature's broken right now, for homework 1, we're going to use average as the proxy. But eventually, we're going to focus on market cap weighted average as soon as Bloomberg fixes their system. Now, what are we doing an average of? Add column, click here, type in return on invested capital, which is a Bloomberg field, select it, and the one we want is at the latest filing. So select latest filing, hit enter, return, or go. I'm going to call that key. It's going to add a column here, ROIC, latest filing. These are the data company by company. The top row is the average of all these numbers. And again, ideally we'd want to have the market cap weighted average. Then we're going to add a column called WACC, WACC, weighted average cost of capital, Bloomberg field, hit enter, select it, go if it didn't. So we now have an industry average return on investment, an industry average WACC, and a company by company ROIC and a WACC. Now this is a template that I'm going to want to reuse. So I can use the save button or the gear button, save as new template, and name it. So I'll name mine 443 fall spread. You can have up to 11 characters. Save it, Now, I'd already done this in a previous class. Okay. So when you save a template, it'll start showing up along this second row of templates. These are your saved templates. So the idea is that if I have a template that I've saved previously called financial cycle time, I click on it for the same list, it just replaces the data with the data from financial cycle time for all the companies versus go back to 443 fall spread. This will be the template that we just created for these companies. So again, this is the template you need to create for homework 1. Save it. We're going to be using it throughout the semester, but this also gets you the idea of creating templates. Okay. Questions about any of this so far? All right, so let's apply our definition of industry attractiveness to the data that we see here. Is this an attractive industry? Yes, no, and why?
Yes, because the ROIC spread over the WACC is around 1%. Is it positive?
Okay. So the answer is you have it right. And I know you're looking at the right information and you're actually starting to use the numbers. And I would probably give you half credit on the assignment. And to be honest with you, across the 3 sections, you gave the best answer so far. So I want to illustrate a point about the harsh grading in this class, because one of the things I said in the syllabus is you have to use numbers, because if you don't use numbers, you could be looking at the wrong information and come up with the right answer. Okay. So basically what I would prefer that you had said is that, yes, it's attractive with the 1% spread positive because the industry has an 8.65% borrowing cost and the ROIC is 9.5%. And that is where the 1% is coming from that leads to the positive spread. So I'm just being hard on everybody now, because starting next week, when you start writing papers, I'd hate for somebody to write 500-word papers and get zeros on them because they didn't use numbers. And that's just something you got to practice in this class. No numbers, no credit. So right answer, just encouraging everyone through illustration to be able to use numbers. So follow-up question. Given this data, does Apple demonstrate competitive advantage?
Yes, because its ROIC is 28.76%, which is higher than the average of the industry, which is 9.5%. Or its spread is 22% versus 1%.
Yes, great catch there, because we're not doing it just purely ROIC, we're doing it based on spread. So there's the point. The spread is higher as the numbers you just gave. So that's why they would have competitive advantage. Question number 2, does Dell have competitive advantage?
No. Because of the fact that if you compare Dell's ROIC to the average, it's actually like 2% lower, and they do have a positive spread of about like 3% or so, but at the same time, if it's below the average of the actual industry itself, I don't know if that would that count as, like, I don't believe that would count as a competitive advantage.
So what's the answer to that? Someone want to answer before I answer?
I would go the other direction. I would say that they are attractive. Even though their ROIC is lower, they have a spread that's 4% as opposed to an industry average of 1%.
So again, using a very simplistic definition, I'd actually say that the last student was more correct in that even though Dell seems to have a lower than average ROIC. They also have a lower risk, 3.5% versus 8.65. So on a relative spread basis, Dell is more attractive because they have a 4-point spread versus the industry that only has a 1-point spread. And that suggests that Dell has competitive advantage, even though they have a low ROIC. Right? And you could argue that they have the same ROIC as Samsung. Samsung is destroying value because even though Samsung has the same ROIC as Dell, Samsung has a cost of capital of 14%, where Dell has a cost of capital of 3.5%. So much higher risk at Samsung, much lower risk at Dell, given the data that we're looking at. It also illustrates more than one company can have competitive advantage. Using the definition we're using in this class. If you guys have questions about this, now's the time to ask. But this is the lens I want you to start interpreting.
I have a quick question. Just looking at the list of companies, would the company with the highest positive spread could be considered sustainable competitive advantage?
Not necessarily. That's a judgment we would need to make. And it could be true and it may not be true. But when we get to next week, we're going to start getting into a framework called EIC, which stands for economy, industry, and company. Part of what we're going to do when we look at the industry and company, which is competitive advantage, is we're going to try and look into our crystal balls and assess sustainability. And some companies / some industries may have more sustainability than others. And that's very important because if we assess that a company has a great spread, but it's not sustainable, then that's not nearly as valuable than if somebody has a great spread that is sustainable. So that's a more qualitative judgment that we would have to make on these companies when we do the forecast.
Okay, thank you.
To go along with that, like, could we, for example, if we look at HP having a WACC of 8.25% compared to like their ROIC being almost 10 times higher, would you say that they're sustainable in this situation, or would you say that it's not?
Well, one of the data points that you're going to read in the book is that ROIC tends to regress towards the cost of capital over the long run. So I'll tell you that companies that make 79% are not the norm, and especially in an industry that's making 9.5. So is HP going to keep making 79 when everybody else is making 10? Long period? I'm not so sure. Like, I'd have to dig into this to understand why are they making 79%. But generally, my bias would be, yes, it's great, but they're going to start regressing closer to the industry spread over time. That's just the way that the world works. Nobody maintains competitive advantage forever. Question's how long? You know, I've been thinking that Apple isn't going to be able to do what it's doing, and it keeps doing it every year for as long as they have. Eventually, I'm going to be right that Apple's going to screw up, but they haven't done it in the last 5 years. So for them, it's actually been very sustainable. Other questions about this? Somebody give me another company. Look at another industry, another publicly traded company.
Pepsi.
Who? Ab what?
Citigroup.
Oh, Citi? I don't want to, sorry for this, but I don't want to do banks because ROIC and banks don't really work together. We'd actually have to flip it to like ROE, and I don't want to confuse everybody right now. So let's stay away from banks.
Did you say you were in a different industry?
Different industry, not a bank.
How about like Delta?
All right, DAL. So here's the point. When you switch companies, little tip and trick. If you switch companies in the top line, it's literally going to do a company search, and when you hit enter, it's going to send you to the main equity screen, and you have to drill all the way back down to the screen. If you search on this kind of orange bar for a company, then when you hit enter, it will replace the data on the template you're at with the company that you're analyzing. So you don't have to, I'm just lazy. I want to keep typing screens, but this is now Delta's data in the template that we had just saved. So are airlines an attractive industry right now?
No.
What numbers are you looking at to make that assessment?
Definitely the negative spread. And also, well, actually, I don't know, because like in terms of the spread, they're like not doing well because their what's it called? Their WACC is higher than their ROIC. But then if you compare it to the industry itself, I mean, the industry itself isn't doing that well either. So it's like,
All right, so
it's
hold
a tough
on.
call.
This is the example of you're not using numbers, so you're being hard to follow. So let's start out with a specific question. Is this an attractive industry, yes or no? And why? What numbers are you looking at to assess industry attractiveness? And what's the definition there?
No, because just about actually all of them have negative spreads.
Okay.
So ROIC is less than WACC for all of the airlines.
But how do we define an unattractive industry? What numbers on the screen are we going to use? It's not all of them.
Average.
Let's start out with the average. Negative 9.17 is the ROIC and the WACC is 6.67. That is why it's an unattractive industry. Now, I don't disagree that this whole industry is in trouble. Nobody has a positive spread in this industry. So I think that's a very valid point. But the industry itself, start with the average, or with the market cap weighted average. Simplistically, does Delta demonstrate competitive advantage?
Yes, but in an unattractive industry.
Why does Delta?
Because Delta has a spread of only about negative 10%, whereas the industry average is about negative 15.5%.
Is Delta creating value? Is Delta creating value based on this data for this period?
For this period, they are not creating value because their return on invested capital is negative.
Yeah, it's not. So here's the point. You can actually, using this definition, you could have competitive advantage even though you're destroying value. And this is the example. Delta is destroying relatively less value than its peers. Kind of like queen of the pigs, right? Doesn't mean they're doing great, just means they're doing less bad, but that's still a competitive advantage using the definition that we have.
I have a quick question.
Yep.
So they're not creating value. The answer is because ROIC is negative, correct?
Well, it's not just because the ROIC is negative, although that would be a big clue, but it's the ROIC minus WACC is negative. And you're not going to have negative WACC, so the ROIC being negative kind of answers the question, but it's really spread. Okay. Negative spread equals negative NPV equals value destruction based on this snapshot of the point in time. Okay. Now here's the thing. Eventually they're going to create value because they have a positive market cap. It's got to be something that turns around this industry. Otherwise there wouldn't be a positive market cap. But the idea is that at this point in time, this industry is not doing well at all. Give me another company. Different industry.
Johnson & Johnson.
Right, J&J. So this group, and again, I'm using the analyst curated list, looks a little different than what we were just looking at. So what would you say here? Is this group of large US pharma, attractive? Attractive, unattractive?
It's attractive because the average spread in the industry is nearly 10%.
Yeah, 15.36 minus the 5.38. So here's the other subtle point I wanted to make here. Is in the book, I can tell you all day long that some industries are more attractive than others. That's why I talked about the 50% Warren Buffett rule. But it's much easier to see in Bloomberg. Like if you're a big pharmaceutical firm, there's something about this industry that you really have to work hard not to do well. Bristol Myers is the clear outlier. All their cost of capitals are pretty similar, and everybody's doing really well except for Bristol Myers. So this is a good industry. It's easy to make money. Or to flip it around, there's no airline doing well. There's just less bad because the airline industry is in such a bad state. And so it's hard for any of the airlines to overcome that. Industries matter. And it's not just the industry today, which is what we're looking at in Bloomberg. It's what the industry is going to be tomorrow, all right? And we're going to make a guess of what that's going to be, and that's going to eventually shape our opinions. But at least structurally, definitionally, we're going to start with the current assessment, and that's part of what your homework assignment is. That's homework 1. So you need to find for me, we've kind of already done it, but a unattractive, value-destroying industry, and you need to take a screenshot, and you need to submit it, and that's your homework 1. Now to take a screenshot, in the upper right-hand corner, there's this little box called Export, and if you click on it, take Window Screenshot, and then if you hit Save, it'll take the screenshot. So if I call this Homework 1, Section 301, it would save it in my Downloads folder, and then in my Downloads folder, screenshot. This is the file that I would submit. Now, there's a reference in there, because somebody had asked about this. At the bottom of the screenshot, it's a serial number. This is the terminal serial number, and there's also a timestamp down to this millisecond. So this is actually one of the ways that Bloomberg does control of their IP, because they don't like their data out on the web, and if you ever started sharing screenshots to a public face, they can go back to the serial number in the screenshot, and they can track it down to you. And you'll get a very ugly call saying, why are you sharing our data outside publicly? So the point of the story is we're also using this for honor code violations. So the idea is every time you take a screenshot, there's an individual serial number and timestamp associated with it. This should never match anybody else's submission in the class. Because the idea is if you're taking your own screenshots, you should not have the same information metadata as the others on your screenshots. So there's another way of just saying, unless I tell you otherwise, you're not allowed to share screenshots. And so you need to take your own screenshots for this assignment, because that's the whole point. The key of this assignment is to start using Bloomberg. So if you're not using Bloomberg, you're not really following the spirit of the assignment. So for homework 1, you need to basically find the unattractive industry, create the template in your account, export that unattractive industry, and submit it, and that's it. There's no write-up. That's all you're doing for homework 1, which is due next Wednesday, 10 a.m. Okay. So, questions about homework 1? Hopefully fairly straightforward.
So for homework 1, we don't have to give an explanation with numbers why the industry is just unattractive. Just submit the screenshot.
No, that'll be homework 2. So homework 1, no write-up. Literally just the screenshot. Keeping it simple. It will get more complicated.
I had a question for the people who had technical difficulties getting access to Bloomberg. Do you think they'll be able to get access before next Wednesday to be able to do homework 1?
I'm hoping you'll get access. If you send me an email, if you have technical difficulties, send me an email. I'm sending over later today a list of everybody that has the problems to Bloomberg. I hope they get it resolved tomorrow. If I find out that, we're going to the weekend and we can't get access, we have problems, then I'll make an announcement and I'll change the deadline for homework 1.
Okay, thanks.
Sure. But right now, I'm assuming this will get fixed tomorrow and you guys will still be able to do homework 1 on time. The homework assignment should take you 5 minutes. Once you have an account. All right, other questions? The homework one. Let's go back to our PowerPoint and talk about a couple more key things. So the next slide we skipped over on Monday is helping us set up some key definitions for the class. And so the idea with this is that we're going to take a hypothetical company that makes $100 million a year of operating profit after tax. The acronym in the book would be called NOPLAT. The acronym in the real world would be called NOPAT. NOPLAT is net operating profit less adjusted taxes. That's a McKinsey term. NOPAT is net operating profit after tax. That's more of a standard term. It's your operating profit, proxy EBIT, times 1 minus the tax rate, simplified definition. Okay? So if we take our $100 million of after-tax operating profit, and we have two choices of what we can do with the money. Choice number one is we can put it back in the business. If we reinvest it, that creates something called the reinvestment rate. The other choice is we can give it back to our investors. We can pay it out, right? Giving the money back to the investors, form of dividend, stock buyback, buy back the debt, make an interest payment. That's considered the payout rate. That's the money returned to investors. Those two amounts, those two ratios, have to add up to 100% of the profits. Therefore, 1 minus the reinvestment rate is the payout rate. 1 minus the payout rate is the reinvestment rate. Okay? And those are really the only two things you can do with the money, simplistically. Now, we can get into a more refined conversation of how do we pay it out? Do I buy back stock, pay out a dividend, for example? But the idea is that either one of those is just a form of a payout. So at a very high level, reinvest, pay it out. And for this simple example, 50-50. Continuing on. Let's assume that this company, which is reinvesting 50 million, has a 10% ROI. It's made a 10% return on investment historically. It's going to make a 10% return on its investment in the future. Well, if they make 50 million and they make 10% on 50 million, they're going to make $5 million of new profits. So if you're on the right, we have $100 million worth of profits now. If we keep making 10%, we're going to have $100 million worth of profits next year. We're going to have 5 million based on our new investment. We'll have 105 million in profits. We're going to grow by 5%. It's just a mechanical way of showing the growth. Now, the other way that we can shortcut the growth is right above, which is the formula for G, or growth, little g in our equations, is if you take your reinvestment rate, 50%, and you multiply it by the ROI on that investment, 10%, investment rate times ROI, ROIC, equals G, also known as the sustainable growth rate. So the rate at which we can grow with internal resources is the ROIC times the reinvestment rate. So in this case, 50% times 10 says that we can grow at 5% a year. The other key definition that I wanted to illustrate is something called free cash flow. A company is not worth the sum of its future profits. Say that again. A company is not worth the sum of its future profits. So that's a misnomer, because you're going to have to take some of those profits and reinvest in the business. It's like saying, I own a car and the total cost of the car is my car payment. That's it. Never going to put gas in the car, never going to maintain the car. It's a fantasy world. I'm going to have to spend some money to operate that car. So the real cost of ownership of the car says it's not just the price of the car, there's gas, there's maintenance, etc. Well, the same thing is true with a company. So it's not that I can pay out the profits. I got to take some of those profits and I got to maintain my company just like you would maintain a car. My buildings are going to crumble. My people are going to leave. I got to invest in it. And if I want to grow, I got to invest more to grow. So I'm going to have to reinvest. So what I can actually pay out to investors is the profit after that investment. And that is called free cash flow. And free cash flow is the theoretical payout rate. Okay. And unfortunately, free cash flow is not a term that we are given by the accountants. They don't calculate that. They calculate income. So we spend a lot of time in finance trying to get the cash. So we actually have to calculate free cash flow ourselves. And in a couple of weeks, you're going to learn how to do that in class. It sucks. Wish the accountants did it for us, but we're going to have to do it because that's going to be key to understanding valuation. Because the real payout rate of the company, theoretical payout rate, is the free cash flow. Profit after reinvestment, which in this case, 100 of profit, 50 reinvestment, 50 of theoretical payout rate. That's the free cash flow. Pause. Questions? Make sense? Assume that's a yes. So, on the next slide, just a little preview of what we're going to do when we calculate free cash flow. At a very high level, what we're going to do is we're going to take the cash from operations, which is the cash coming from the income statement, and we're going to subtract the cash reinvested in the balance sheet, which is the change in the balance sheet, change in the operating investments. And that is how we're going to get to free cash flow. Okay? But that's coming. There's more a simple conceptual version today. I want to get to this slide because this is actually, there's a lot of data here. It looks like a boring slide. It illustrates another critical point for the semester. So the company that we've been talking about is Company A. So this is the company with 100 million of profit, 50 million of reinvestment, 10% ROIC. And what we're adding to Company A is the idea that there's a competitor called Company B that also has the same cost of capital. They both have a 10% WACC. It's the same risk between A and B. And B, its competitor, has the same profits. It also makes $100 million a year. And those profits are also expected to grow sustainably, G, at 5% a year. 100, 105, 110. Given this data, which of these two companies is more valuable and why? A or B? Which of these two companies is more valuable? What do you think?
I think company B is more profitable because it has free cash flow of 75, 79, and 83 years 1, 2, and 3 respectively versus company A of 50, 53, and 55. So it has more money to return to shareholders. Okay.
I would actually agree with that because we said that the value of the company is based on the free cash flow because that's the theoretical payout rate. So it would be B that should be more valuable than A. So absolutely right. But what's also important is why. Why does B generate more free cash flow than A?
Their reinvestment rate is 25% lower than company A.
So they're spending less to generate the same profits because they have a lower reinvestment rate. How can they do that?
Their return on net investment is 20% as opposed to company A where it's only 10%.
Exactly right. So what you guys have just illustrated is that, and I'll caveat this by saying at the same level of growth, if you have a higher return on investment, you will generate more free cash flow. You will be more valuable. ROIC will equal your free cash flow. Because here's the point. Company B is better at what it does. It makes 20% per dollar of investment. A makes 10, which means they invest half as much to generate the same profits and therefore more free cash flow. Or let's say company B invested the same as company A. They invested 50. Well, guess what? At a 20% ROI, they'd have more profits minus the same investment. And in either case, they would have more free cash flow. So more ROIC, more free cash flow by definition. That's what I want you to start to understand. So calculating free cash flow is hard. Calculating ROIC is far easier. McKinsey, the valuation book, basically realized this, and their entire approach to valuation, ROIC. McKinsey's the ROIC company. All the textbooks are cash flow companies, right? It's not that they don't get to the right answer. They both get there the same way. The difference is it's easier to take the ROIC-based approach in valuation. Think about this. Key value driver equation. That's on the next slide. What is the cash flow based on? The cash flow is based on the ROIC that you earn. So, and the investment rate. So that's where all this stuff is leading. But the point I wanted to illustrate in this slide is, and again, caveat for the same level of growth, more ROIC, more free cash flow, more value, right? Now, in the real world, what gets tricky is that the growth isn't always the same. So you can have a lower ROIC and a higher growth rate be worth the same as a higher ROIC and a lower growth rate, okay? So you can get there different ways, but that's the point. I can look at different levels of growth and figure out what the value is. But this is the growth spread combination that will eventually matter, key value drivers, talked about it Monday. But this is just working backwards to say ROIC, proxy for free cash flow. Questions?
Does the investment rate for company B being lower have to do with the return on net investment being higher, or are those two things separate from each other?
So for purposes of this example, it was set up so that they would kind of work out to be the same, just to get the same level of profits. But they can be disconnected, meaning the investment rate is how much I'm choosing to put in the business, and the return is how well I'm doing on my projects. And they're not always connected, because I could actually make some really bad investment choices. I could invest a lot and not get good returns, right? I can also get great returns, but not have a lot of projects that I could find. So they're not 100% correlated between the two, and you don't always trade off, right? So it's about your incremental decision as a leader. What do you do with that incremental dollar, right? And what you're going to eventually realize is that value creation comes down to, okay, I made profit. What do I do with this profit? If I think I can put it into the business and make a positive NPV, if I can generate higher spreads, then I want to reinvest it. If I don't see an opportunity to reinvest and make a positive spread, why would I want to put it back in the business? That's when I would want to pay it out, okay? And that's where the decision for what the payout rate versus reinvestment rate theoretically should be. But then externalities come and kind of get in the way of some of that stuff. But generally, that should be your philosophy for investment versus payout.
Thank you.
Other questions, comments? All right, so let me do one other quick example here. Do this on the whiteboard. At least try. Share a whiteboard. All right, so we have a company, and their CFO puts out the following goals. We're going to have an ROIC target of 10% per year. We are going to grow the business 10% annually. We are going to maintain a 50% payout ratio going forward, pay out half our profits, and no new financing of any type will be taken out. Financing. That's supposed to be financing. Select. There it goes. And saying new financing. Okay. And the question is, can they do this? What do you think about these goals? Can they meet these goals?
No, they can't. They can only grow at 5% annually.
How'd you come up with that?
Just taking the investment rate, multiplying it by the ROIC to give the growth rate.
So the investment rate is what?
50%.
Because 1 minus the payout rate is the investment rate. And the ROIC is what?
10%.
So that's going to give me a G of 5%.
Yep.
Basically what I just wrote out.
Yeah, that's what I did.
Yeah, that's exactly right. So this is where everything we started to talk about triangulates. So we can use as analysts some of this data to help us when we forecast and understand what's happening for a firm in the future. And companies will sometimes put out these reasonable sounding goals, and the answer is they actually can't do it. Because if you give me a growth and you give me an ROIC, I know how much you have to spend to get there. If you give me an ROIC and an investment rate, I kind of know how fast you think you're going to grow. So these numbers start to work out. As a matter of fact, let's say that actually I decide 10% growth is the one of these numbers I'm not going to change. So how could this company grow 10% annually? What could it do? Assuming it didn't want to borrow any more money.
I remember now.
What could they do?
They could reinvest all of their earnings.
Yeah, they could switch the payout rate to 0, 100% reinvestment. That would get them to 10%. What's another way they could get to 10% growth? If they didn't want to slash the payout rate to 0.
They could take on more risk.
Yeah, find 20% projects. Like that's easy to do, but there's the point. There's some trade-offs that we can make, but something's going to have to trade off because the original target isn't going to make sense. So either we have to borrow more money, we have to pay out less, or we got to find better returns. But this math isn't going to work. And I give you this example because a few years ago, I literally pulled a CEO aside and I said, look, you just gave this presentation. You can't do what you just said you were going to do. The guy looked at me. He's like, what do you mean? And I actually said, look, I'll do the math. Like, this is the math. Your numbers don't add up. I went back to a CFO and he's like, what the hell are we going to do? So this is not always stuff that's obvious to people, but I'm saying like, you're going to start to understand what you do as a business in terms of the valuation stuff with a lot more detail as we get into how these concepts work, right? So again, this is what led to the key value drivers that we talked about. But for purposes of next week, for homework 1, we're gonna keep it simple. So as a reminder, make sure you get your Bloomberg account. That's step number 1. See a question down here in the chat. So number one, get your Bloomberg account. If you had trouble because you used the class code in getting the Bloomberg account to log in, send me an email and I'll manually ask Bloomberg to add you, or you can send them a help email from your UMD email address and they can also add you that way. Basically, then go to RV in Bloomberg, find an industry that has a negative spread. Hint, we found some today. Take a screenshot of that, upload the screenshot. That's homework 1, easy 2 points. Right? In addition, I'd start reaching out to your teammates again. And more importantly, I would start on the certification. That's still due 2 weeks from Friday. Right? So you need to be certified as well. All right. Monday is Labor Day. We're not going to have class. Hopefully you guys don't do anything too stupid. And we'll see you next week once you get back. Right? We're done a little bit early today unless anybody has any additional questions. All right. Send me an email if you had trouble with the registration. Otherwise, I'm going to end the recording. Have a good day.
Thank you.
All right. Bye-bye.
Thank you for